ballparked this event as a 20% decline in U.S. shares, with those impacted industries and some international markets that are higher beta taking a larger drop. And we can't be exactly precise if it would be a 25% down move. I think that what's happened recently with credit markets having weakened and still to pass that impact, particularly outside of the energy sector on to markets, is a negative outcome. It really begs for a stronger policy response. Ultimately here, we're facing what is akin to a natural disaster. It's something that is, as Mark Carney said today, it's not a financial crisis. It's not a business cycle that had boomed and has to go bust. So we could take a very sharp hit here across the world economy in the first half of the year and, in fact, rebound from it. So I think that, again, argues for something that I would ballpark at 20%, with much worse, of course, in some areas, rather than pick some, massive number.
So not really that far from where we are right now. Omar, I'd like your view on that question. And also, I wonder if you can distill the impact of Russia-Saudi. How much incremental weakness do you think that delivered?
Well, I do think that part of the weakness in oil was probably what pushed a lot of the markets down even further and elevated the volatility more than what it was necessary given the economic conditions. I think, to specific to the question about whether there's more downside here, I do believe that a big part of this is that the market's still just pricing a lot of uncertainty. I think a lot of what we have seen so far is just market doesn't understand how long is this going to take and what are the answers that nobody really knows. I think a big chunk of these has to be with the fact that people are thinking about an earnings recession that may just be there already, and then understanding what may be the possibility of an economic recession. I think the market will have more downside if an actual economic recession is more likely. And probabilities are increasing as we speak. As the more this takes time, the probability of recession gets higher and higher, and therefore the chances for a bear market are actually more, pronounced.
Steven, we were talking just now about your base case and a 20% drop due to COVID-19 impacts. I wonder how much of that factors in the sort of adverse credit market impacts that are possible from these low oil prices. Are you factoring that in at all, or does that 20% kind of assume that there is some sort of stimulus response or some kind of support that keeps the credit markets healthy?
No, we need to see disaster assistance. We need to see impacts to get us to make certain that we are not damaging economic potential and the ability to rebound. Travel and tourism, forget oil for a moment, but just the ability of global airlines to operate in a period after they've had an incredible demand shortfall, that is critical. So, look, we can have what has gone on here, this surprise, not from the demand side, but Russia and Saudi fighting over, again, who will make the next cut. And oil production, that's one issue. What I care a lot about is that we have credit markets and healthy parts of the economy around the world not hit a downward spiral. So in other words, when we've hit unnaturally low levels of economic activity, well below satisfying demand, that we're not starting a new downturn from there. And we're not assuming, in fact, that credit markets have to have that downward spiral in healthier parts, right? That's what would make it a lasting full-year economic recession as opposed to a very short, sharp shock. Again, the signs have not been good for the last couple of days, but again, this is why you do need a policy response to protect the healthier parts of the economy.
Yeah, it's certainly what everybody is looking for, waiting for, those details. Omar, going back to your point about earnings recession, I mean, we have now seen hundreds of companies come out and either revise, couch, or in some cases even pull their guidance altogether. From a fundamental perspective, how are investors, especially maybe longer-term investors, to get their arms around the situation and what this is going to actually mean for these companies? Does it essentially mean that you're going to continue to see these big moves in the market until we start to get some more clarity around earnings in the next season?
There's no question in my mind that the volatility will continue to stay like this, even, as we get news on stimulus, whether it's monetary or fiscal. Volatility in this part of the earth has to do with the fact that a lot of the estimates of earnings and a lot of the estimates, even on economic data, are actually going to be incorrect, or there's just going to be not in the ballpark of what is going to be reality. What we know is that the impact of the coronavirus in earnings and in economic data is still by far very unknown. We don't know to what extent this is going to hit bottom line of companies. We just know it's going to be there. And I think with that in mind, it's really just trying to estimate how much further down, or potentially how much potential positive surprises that might be in the market. I think volatility, and especially when it comes down closer to reporting earnings, is going to be very critical, and therefore the periods of volatility will continue to stay in the market.
Yeah, it's a key point, Steven. The data that's headed our way over the next few weeks is going to be soft at first, soft data before we get harder numbers. And we've talked for a year
I think you might
about
see some strong data. Yeah,
you might actually
see retail
surveys,
sales
ISM,
strengthen.
What specifically?
Yeah, look, things like China's manufacturing downturn was remarkably deep and hard, partly because of Lunar New Year migrations, people being out of place and then stopped from returning to the factories. I think that the disruptions in the U.S. economy have been small, but the negative impact is still coming, right? You may not see it in the data. Estimate uncertainty, particularly for the second quarter. I think the largest negative impact will be in the United States in the second quarter. So just again, having estimates, just having any notion that you can guide and say what the year would be like, you actually have to discount that quite a bit. And that's why markets are falling.
So if Michigan comes in and confidence is not severely dented, are you saying don't necessarily trust it?
Generally speaking, yes. I mean, we just saw small business confidence increase for the month of February.
Yeah, but that was a February number, right?
Right. But again, there will be new data points, and I'm sure that there will be some impact, but it's not going to capture the actuality of what's happening here. When Angela Merkel in Germany can tell the public that 70% of the public will get the infection. Now, again, maybe that's if they don't do anything about it. But we really have, again, to come to grips with what will happen to public health systems, what will happen, all of the hoarding behavior, to distortions to economic activity, a massive drop in travel, tourism, and transport. All of these are unnatural things. None of this has to outlast the virus. But figuring out exactly how that will play out in a GDP report is probably not that important right now.
Omar, we got a shot at some data, or at least some color, from a couple of decent-sized tech companies, Adobe and Broadcom, which are reporting tomorrow. Given this environment, what would you hope to hear them say either about guidance, about demand? What should investors expect and listen for from these companies as the executives try to give some idea of how they're navigating this uncertainty?
I would probably say that I would be surprised if any company that come out and try to revise their outlook will not acknowledge the fact that there is a lot of uncertainty regarding of what the impact may be of the coronavirus. I think most companies will come very conservative in trying to set expectations low to make sure that whatever the earnings reports may come down the road end up being more closer to reality. I don't think anybody really has a good gauge of what these, constrained consumer demand and the shock to demand that we're seeing in the system will have an impact in their earnings down the road. What they know is that their impact is going to be negative, and it's obviously going to affect their business. It's already affecting their business, and the lagging effect on how that, is in earnings is probably going to take a quarter or two before we can actually see the real earnings. So I would be, expecting for them to be realistic and provide that low set of expectations to make sure that people realize that, everybody is really just trying to wait until we can have a good gauge of what the final output is. And I don't think we're there yet.
Yeah. So to wrap all of this up and make it actionable before we let you both go quickly, Steven, how are you advising your clients right now in light of all of this stuff that we're talking about? And then, Omar, quickly, I want your response too.
Look, we've taken some defensive actions. We're 5 percentage points overweight U.S. Treasuries. overweight gold. But the reality is, don't redesign, don't throw out your long-term portfolio, because this is an unnatural disaster and it will pass.
Omar?
Big part of what we have been discussing with clients is to stay calm. This is the reason why you have a long-term financial plan. Periods of high volatility happens, and then there will be more of this coming. And this is the time to stay disciplined, continue to follow your long-term objectives, make sure that your risk tolerance is in the right place, and don't try to speculate on market time where the bottom is going to happen or what is going to be the effect of it. To stay clear to what your plan is and focus on the long term. A year from now, we will be talking about something else. And that's a big part of what we try to gauge with our clients.
Yep.